want to start asking about those different segments of Google's business, Google being the part of Alphabet that makes the bulk of the money. Now, direct response, they were saying, the sorts of ads that prompt people to download stuff, those are doing better than brand advertising overall. The cloud business also generally doing well. This echoes a bit of what we heard from Snap a few days ago. What's your sense of how much of Google's revenue remains relatively stable in this crisis, and how much of its revenue is seriously at risk going forward?
So direct response, particularly within YouTube, was strong relative to brand. But Google does have 70% of revenue that's really tied to GDP growth. So if you look at the search business where buyers are actually buying keywords that are tied to specific commercial content, that business was very directly impacted, even though that's direct response as well. In fact, there was from Q4 to Q2 2020, there's roughly a 25 percentage point deceleration in the search business, and on the YouTube side as well, very meaningful deceleration. But direct response within YouTube, buyers that are in different categories, so say travel spending in direct response on YouTube may decline. Someone else can come behind that and actually spend in that category, whereas you're not going to have someone, a Wayfair, purchasing travel keywords on the search side. And then finally, within cloud, it's kind of interesting because cloud overall grew 52% in the quarter. Even the GCP component of that grew faster, but yet Google is pulling back on data center spend, which doesn't actually, kind of jive with the cloud business being as healthy as it was at the outset of the year. And here we sit, despite these decelerating trends in the business, and the stock's basically flat year to date. So, we're optimistic long term on Google, but it's just kind of odd, that the stock's so strong and healthy and stable, given that the deteriorating trends that continue in the business.
Now, Scott, what do you read into that cloud guidance, or at least color on the guide, especially given that Intel said that they expect the spending from mega-scale cloud providers to continue at least into Q2, though the second half was a little bit hazier. Does that mean you think the others might be spending or allocating resources differently than Google is, or do we just have to wait and see?
I think it's a wait and see. It's really hard to know exactly why Google is pulling back on data center. I mean, of course, they're pulling back on headcount, they're pulling back on marketing and buildings as well. So it's really across the business. And some would say maybe this is an opportunity to trim fat in an organization. And so Google's still very much leaning into growth in the cloud business, but being more disciplined about it. And that's as simple as that. But if you were to hear this type of commentary in a normal economic climate, you'd be seeing a sell-off across the tech supply chain, because it would be indicative of a slowing in the cloud business, at which revenue multiples are extremely high.
Yeah, to that point, Scott, I'm looking at the stock. It's up 9% right now. And obviously, there are a lot of different businesses and key metrics within Alphabet overall. And this is not a company that, even in the best of times, is issuing guidance. But that being said, what do you think is driving the move right now? Is it that commentary and the fact that it is seen as positive relative to the doom and gloom of recent weeks?
I would say, one, it's better than feared. It's a little bit of rate of change, meaning things are not getting worse. And then I think there's a little bit of investors wanting to hear what they want to hear versus what's actually being said, because the CFO, Ruth Porat, didn't really say that the search business is improving. She said it's not getting worse, which is rate of change. It's not getting worse, but it's certainly not improving at a rapid rate. And if you look at our estimates for the year, we have a gradual improvement in the business throughout the year, but my visibility, anybody's visibility into the second half of this year is very limited. So if you're making like a significant bet on improvements based on the commentary in that call, it's debatable. And so, we're a little bit more cautious at the moment, even though we do love the stock longer term.
Hey, Scott, there was a universe of investors who loved this name and maybe still do because of the optionality behind other bets. We call them moonshots, for lack of a better word. When you hear Ruth start to get so disciplined on costs, what does that do to the long-term picture of things that they would bet on, even with a maybe smaller than even chance of success down the road?
I think the spending habits at Google and Alphabet broadly will recover over time. So I don't think that there's any longer term project that's impaired by this period. But at the same time, it is important to kind of focus on what's actually happening at the company right now, particularly given what's happened with the equity and equities across the board relative, to those longer term themes. So you can be constructive in the long term and somewhat cautious on the near term. Fundamentally, though, I really don't think that anything will ultimately change at Alphabet, and the projects like Waymo and otherwise will get the funding that's required to allow them to grow.